GM everyone, and welcome to Flywheel, your number one source for everything Frax, DeFi, and everything in between. If you want to know what is going on in the world on chain, you've come to the right place. This is DeFi Dave here with Capital K, and we are here to help you harness the power of the Flywheel. And on this episode of Flywheel, we go into the wonderful world of interest rates and interest rate swaps and derivatives. And we're here to brighten your day with Julian from Illuminate. Kit, what are your thoughts on this one?
I think it was very enlightening. I think he definitely shed the light on what is a very, dark and mysterious part of the market, which is called fixed income and fixed yield. So I think that the readers and the listeners are going to have a great and educational experience. But take out your notepad because Julian goes deep and he goes hard and he goes fast.
Yeah. And it was a great conversation overall. You know, we really got into it, learned a lot about this subsection of DeFi, which has a lot of action and a lot of potential and opportunity. And so that's why I really enjoyed this interview. And if you want to catch all our interviews, make sure you hit that bell button and subscribe. Leave us a comment down below. Subscribe to our Substack. Follow us on Twitter at Flywheel DeFi. You can join the Telegram at Flywheel DeFi. You can follow me on Twitter at DeFiDave22.
You can follow me at 0x_K.
And let's get the flywheel spinning. Do you hold ETH but don't know what to do with it? Want to earn those juicy liquid staking derivative yields but don't know where to start? Well, FrxETH is there for you. FrxETH is Frax's native LSD solution, allowing you to earn boosted yields in multiple ways on your ETH. If you want to get started, go to app.frax.finance and turn your ETH into FrxETH today. Welcome back, everybody, to Flywheel. And on this edition, we are here to brighten your day with Illuminate. We have on the founder of Illuminate, Julian, on. It's funny because, Julian, I did demo your product a few months back. So I'm actually very excited to have you on so we can talk about it, talk about the progress, and talk about the FrxETH collaboration you have going on. So we'll get right into it. For people that are unfamiliar, what is Illuminate? What problem are you guys trying to solve? And how does Illuminate bring a solution to it?
Sure. First off, thanks for doing the interview, right? Those are very important early on. We did kind of launch out of what is really stealth this past week. So having folks that we can actually access early on to actually get feedback is pretty difficult, obviously, when you're in stealth. And also we'll be doing likely another round of those now that we're live to kind of get some more legitimate feedback. Every time you use a DeFi product, it always feels a little different when you're actually paying gas for it. So that's a big consideration. But yes, so what is Illuminate? Well, Illuminate at its core, it depends on your point of view if you really want a technical description. But from a user's perspective, Illuminate should be the only place you ever go for fixed rates. That's our goal at the end of the day. We serve as an aggregator across about 10 different protocols at this point to aggregate fixed yields. It's very easy to come into our interface, choose your asset and maturity, and we are at that point guaranteeing what is effectively the best rate across Swivel, Element, Notional, Tempest, Yield, Pendle, APWine, and Sense. And then soon TM, there's another few in there. There's Exactly, TimeSwap, IPOR, Volts, and Napier.
Yeah, can we actually get a picture of this whole fixed rate landscape that exists in DeFi right now?
Yeah, it's growing, right? And I think that is the core of our thesis, is that there is this massively growing fixed rate space, but there is no real way to honestly, as a user, use them at a core level. And then more importantly, if the space is growing and I'm listing all these projects, there's no real way to actually integrate them and utilize them within your infrastructure, or actually to deploy if you're a large DAO or anywhere else. There's really no sustainable way to deploy capital. So that's really where we came in and made our slogan DeFi Fixed, right? The idea is that we're trying to fix a lot of the issues that exist in DeFi, and also as well like make DeFi fixed, right? Like grow fixed rates.
Yeah, it's a good pun. You
Yeah,
said something
great pun.
about DAOs and their treasuries and being able to deploy. What kind of issues do DAOs face with their treasuries, and how does Illuminate and fixed rates in general help with it?
So I would even actually differentiate even further between two categories of users. There's like
Okay.
DAOs in general that have treasuries, and like should they get yield? Maybe, maybe not even. Like it depends on your point of view at this point. There are plenty of those out there that, especially last year and ongoing, there are a number of DAOs that literally are just trying to get the best yield possible on their capital. This includes pretty much every Olympus fork or Ohm fork. And beyond that includes places like Maker, where of course they need to increase the supply of DAI, and the way they do that is they deploy it out to like effective liquidity venues. Same thing with Liquidity, and then other places like Yearn or Idle, is a place like this, which are effectively not hedge funds because that's a bad word for it, but they need to deploy liquidity and they need to deploy it optimally, right? So I kind of separate these folks away from people that are just purely managing their DAO treasury. For the DAO treasury people, it has been a little bit more sustainable, just like strictly they can deploy a little bit. If they don't need the capital for a while, they can get some yield. The issue there is, at least for now, protocols are too nascent to, one, deploy a significant amount of capital. Two, that's kind of the story across every different user base. But then specifically there, they're too nascent to really trust with your treasury. And this provides a lot of problems. And I'm going to ask a question from you guys here. And this is commonly asked of us, but there's kind of two spectrums of risk. There is concentration risk, and then there is just like general smart contract risk. And I'm interested in whether you guys think of diversification between smart contracts actually as a reduction of risk, because, hey, your capital is now split across maybe 15 to 20 different places, or if it's an increase in risk because now you're worried about getting hacked on 15 different platforms, right?
I would say increase in risk. I would feel much safer in one protocol that I know is Lindy and that I know is battle tested than I would across 15 different protocols, because as we saw with, it doesn't matter if a protocol's even been around for like a short amount of time, long amount of time, or how it's perceived as a blue chip or not. Like, you're spreading your risk across 15 protocols. I think DeFi is too nascent right now to ignore that. So I'd rather just concentrate in one protocol. I'm not sure about you, Kit.
I think for me, the number 15 is quite large. I feel like I would be much more comfortable with like 5, right? If you had changed that to like
5,
instead of 1 or 5, I would choose 5, just as the natural diversification dogma in me just pushes.
Yeah.
What about you, like Julian? I don't have a good answer. If I'm trying to advertise my product, I of course say that the diversification is a reduction of risk, right? And this is present. Inherently, if you're using this aggregator, you're effectively purchasing what is a basket of principal tokens, and that means that at this point, our first market is diversified across yield, notional, sense, and swivel. So that if any individual protocol there is ever hacked, your maximum loss is limited to the basket, and then we have a deposit limit, a rate limit that prevents anything beyond the current deposit. So this is like, I can't advertise it as a reduction of risk. The Yearn guys likely would advertise it as a reduction of risk, right? Like, they were exposed to Euler, for example, but if you had deposited to Yearn, you only lost maybe 1% or 2%.
And Yearn has a track record of making people whole. Like, they had that $11 million hack. So that also goes.
That's exactly what they did. Actually,
that goes into also like where I feel safe depositing. Is like how they reacted to exploits in the past.
Yeah, this wasn't on like the topic list, but the Euler stuff itself is very like, I don't want to spend too much time on it, honestly, because I'll end up talking crap rather than just briefly touching on it. But yeah, I was impacted personally. Swivel was impacted. We had like $1 million of a market going on there, and let's hope that they don't screw things up. Right now, I'm not the biggest fan of the current proposal. So
what's the current proposal?
Essentially, they are benchmarking your balances at the day of the hack. So let's say that you had, and this is me, you had deposited staked ETH and borrowed stablecoins. So I do this always. I deposit my ETH stack and I borrow stablecoins to then max leverage and provide liquidity to my protocols. And
Good
what
man.
that
Good man.
yeah, what that effectively means is that I my price was benchmarked at $1,600, and they're effectively liquidating about $100,000 of Ethereum Vine at 1,600 when today it's 1,900. So I'm essentially losing about 15 to 20% there because of this, and then the proceeds they get from that $300 differential is being distributed proportionally to all users. So if you're sitting there and you had just deposited stablecoins, you're actually going to be making all of that money from me. You're going to be taking my money.
I'm curious. How do you like past hacks in the past? Like, let's look at like Mount Gox. Do you know how like Mount Gox works? Is it like day of?
Yes,
it's like
it's a little bit different with bankruptcies. And this was actually one of the comparisons that was made, and I made a stink about it because it's clearly not bankruptcy. And that bankruptcies would require that all of the equity holders are paid out last. And in that case, all of the treasury would be completely run out. Euler has $25+ million in cash in their treasury, and then they have another $7.5 million in insurance funds that have been paid out. So they have $32.5 million to ensure that nobody takes a loss on this, and they haven't indicated that they're going to spend that at all. So
why wouldn't they just make people whole, just like completely? I think that would seem like the optimal outcome.
That gets back to your original point, which is like you want to use protocols that just do that. I would continue to use Euler potentially if they do that. And if they don't, it pretty much means that they're, in my mind, they're giving up on this product. They'll likely do a rebrand and release whatever the other stuff was they were working on.
Guys, can you give me 1 second? I'm going to adjust something right here.
Yeah, all good. I'll just speak a little bit on Illuminate. So actually, on the previous hacks, actually is a good example. The only thing that is really important for the Euler team to do is to just not take too long. Last year, the thing that killed Rari was purely just like a lack of urgency. It took Rari 3.5 months between the hack and the Faye final repayment. And during that time, there was obviously insane price disparities. They waited initially because Faye didn't want to, like, ETH had dropped from 3K to like 2,500 or 2,400, and they didn't want to eat that price differential. They waited and waited and waited. ETH dropped to 1,400, and that meant that they could not recapitalize the protocols completely, and both Faye and Rari were closed down, literally just because they were trying to be greedy with their treasury.
That was literally going to be my next question. Statement was like, oh, this kind of irks of not the same, but like
you'd hope
in
it
the
doesn't,
same
man.
Greed, man, greed. That was such a pain.
We didn't die, right? We got covered. We had actually exposure to that hack as well. Luckily, it was in Faye itself, so the Faye team implicitly had covered that already. But that killed Babylon Finance. I don't know if you guys remember them at all. They like
I remember hearing about that.
They had raised like $10 million, and just like all of it is very sad. So let's wrap up to this topic a little bit, right?
I would say to wrap this up, the one positive thing that came out of the whole Faye debacle was it was very contentious, but there was an on-chain solution that the Olympus guys came up with Frax, and the fact that everything was resolved on chain, and Frax and Olympus didn't get 100% back, but they didn't get nothing back either. They got some, at least there was some resolution on chain, and it shows that like, hey, we can take care of our own business, which is really important in the eyes of outsiders to show that we can do that.
I actually was getting together with the Frax and Olympus guys like as that was ongoing to try to push that and figure it out, right? Like I honestly don't think that things will move to the chain this time around. Just the indications of the other team. They haven't asked whatsoever, honestly, for anyone's opinions. They've just said, hey, this is the plan. They haven't responded to anyone's questions on anything. The last word was, hey, check out this contract that we built for the claim. and there's like half of the README is for the contract is the legal disclaimer saying this gives up any rights to sue them.
Yeah, it's gonna be interesting to see what happens within the next week and a half after this is released. So to be continued. But
to be continued.
Let's bring this back to fixed rates. So I'm curious. What does demand look like in the world of like fixed rates and DeFi?
I'd say at this point, most of the demand is on the borrowing side. So you've seen most of the scaling come from, at least until the past few months, I'm specifying because there has been some recent action. Up until the past few months, it was almost completely action on yield and notional, where people could just collateralize and borrow, let's say at a 1 to 2% yield. And of course, that's going to be very, very profitable if you're just able to beat others out. That said, there's also been a lot of growth recently on like layer 2 and alongside things like GLP and other just more interesting mechanisms. Places where it's not necessarily direct yield that's always being tokenized, but other more abstract forms of yield that can also just be utilized in fixed rates. So, I mean, I'd shout out Pendle. FlashStake is a new one that's launched. All these guys are targeting different places. And then I think really for fixed yields, what's most sustainable, I mean, it depends on where the T-bills go, but is staking, right? With rates around 4 to 5%, it is still difficult to reach out to external source of capital like family offices, etc., and really onboard them. But what you can do is offer like through FrxETH fixed rate staking products, right? And these are competitive. When you start to consider things like dilution, right? And I'm actually interested, just a quick question on this. Do you guys think that we will get more staking or less staking post merge there, or post withdrawals, I suppose?
I think we'd get more staking.
Yeah.
Because people would get more comfortable. Yeah.
Yeah, like exactly. It's like it's a bullish withdrawal, right? So at that rate, there should continue to be significant dilution in stakes, right? To the extent that it makes a lot more sense actually to get fixed rates. But beyond that, there's also there's a ton of really, really interesting things that can actually be built when you start to tokenize fixed yields. And I think one of the examples is probably deliverable block space features. So are you guys familiar maybe with Alchemia?
I'm not.
Cool. They're not really a DeFi project because they kind of sit off chain with more node infrastructure. But the idea is that they really do just yield space tokenization through this other stuff. And once you tokenize yield, you can effectively isolate the actual transaction demand component that is going through this, right? And at that rate, you can start to do things like hedging your transaction demand. If let's say a larger party, and I'm not going to shout out any specific partnerships here, but there's a few relayers out there that allow you to pay for another user's transactions. And these parties already have agreements in place to just hey, you pay me ahead of time and I'll pay you for your transactions in the future, right? However, the issue with this setup is that when you take on that amount of risk, you have to charge absurd sums for that kind of deliverable future block space. And what yield tokenization then allows those parties to do is to actually hedge off all of that risk by longing the rate at the same time, longing transaction demand. And all of a sudden you can create way cooler financial products there, right? Like if Matic needs to commit 20 transactions a day, this is the case for them, they need to maybe spend 20 million gas a day, you can guarantee them fixed costs on those transactions, which traditionally are where stuff like interest rates really find demand, rate swaps rather. Is when one party has some sort of variable cost that they need to fix in place to ensure that their organization or business is sustainable. Sorry, that was a few answers.
No, that's really interesting. Yeah. No, that makes complete sense because I'm quite familiar with relayers from my time at Gelato and their work with bridges, and so guaranteeing a fixed rate, for those organizations that need it is really a game changer. I mean, it's kind of like if you go back in 100 years ago or a few hundred years ago in agriculture, guaranteeing a fixed rate on the yield, whether it's wheat or whatever crop you grow, to
Precisely.
ensure. Yeah, it's the same exact thing, but instead it's with block space.
Yeah, and it's a way larger market that I expect will grow over the next year.
Hmm.
And I mean, even at a simple basis, though, I'll just kind of bring stuff back full circle. Lending at a high fixed rate on ETH or any, honestly, staking infrastructure is just attractive. The yields are more volatile than elsewhere. And if right now, let's say, I think FrxETH is around 6.2%, maybe I'm
Hmm.
misquoting there. If we're able to offer about 5 to 6% on that, that's solid. And there's like other enhancements we'll be able to offer even to kind of eclipse the yield that staked FrxETH could offer in and of itself as well. Yeah.
So question for me, Julian. Who's taking on the other side of the variable rate then? If I'm locking you in, that means I'm eating the volatility, right?
Yeah. So if you're taking the long side and you're essentially just taking on all of that volatility, you are a few users really like your trading rates, you're arbitraging them cross platform if that is possible. Previously, without Illuminate, that honestly wasn't possible. Or you have some bespoke position, right? Like you understand that, especially with staking yields. Let's say if there's gas prices have gone down to 10, there will be an opportunity to long gas prices. There's essentially value statements there that you can make. And on the other side, I actually think that it's at this point more difficult to find people to lock in a fixed yield on things like USDC or elsewhere,
Mm-hmm.
where traditional rates are still higher than they are in DeFi. And that's kind of this wider macro statement that we should be longing. Yeah, I guess when you guys when you guys look at the risk profile of a fixed rate in DeFi, what would you guys really expect, I suppose, compared to, let's say, just deploying to a T-bill?
Yeah, I mean, the fact that rates are higher, with T-bills makes it automatically less attractive in DeFi. Like the only place where I honestly see an attractive, stablecoin yields are FrxLend, where they're like 7, 8, 9. Hell, the other day I saw was at like 10%. So
Yeah.
that would be like the only place where I would find attractive stablecoin yield in DeFi that's organic. But that's just how like FrxLend has been with the way people are using CRV as collateral and Geom as collateral, and
Yeah.
yeah.
I mean, I'm up in there. I'm using a bunch of staked FrxETH. It's like
Mm-hmm.
it's the best folding strategy right now is not actually folding and borrowing ETH. It's borrowing. I mean, it depends on how your position is. I'm actually relatively market neutral right now,
Mm-hmm.
so I can borrow stables and then buy ETH with it. Essentially, I borrow Frax and then buy ETH.
Yeah,
Stake it again.
I have a
Yeah.
question. So, what do you think? How will protocols that are set in stone that took decentralization as their number one priority, whether it was Rye or whether it was Liquidity, how do you think they're gonna evolve in this world of staked ETH when Shanghai goes live? Because the staked ETH is obviously more attractive than the ETH, and you're just leaving money on the table.
They. I actually need to look more in detail about how locked in and immutable they are, because something tells me that they're able to add some form of collateral there, right? Like it would blow my mind if Liquidity is unable to add stake ETH. Although actually, it wouldn't blow my mind; it just would surprise me. Is the way I'd say it.
I think they would have to fork and start a new
There's
program.
they're gonna
Deploy another
have
contract.
difficulties.
Yeah.
Yeah.
You have to grow the supply of your stablecoin by offering low yields. However, if you're offering ETH as your stablecoin, you're immediately going to be hitting the lower bound problem, where you're going to hit 0% because the collateral itself isn't earning anything. So you have to inherently offer a lower borrowing yield than anywhere else to kind of hedge that. But if everybody else, let's say if Maker's already at 0%, does Liquidity start giving negative yields to like make people close their positions and like come back to peg, or how do they expand their supply properly?
I mean, that's the problem with like their model. It's hard to.
And it becomes more difficult. Let's say if everybody else, and so Aave has V3 and Go, right?
Mm-hmm.
And Maker is launching Spark, which is a fork of Aave V3. So essentially, their stacks are going to be almost identical. And the goal of both of those infrastructures is to provide bare bones low borrowing costs on stablecoins. So again, like, I don't know how you can compete. Let's say if I can throw my Frax staked ETH up onto Maker's Spark protocol and borrow DAI at like 0.25%. It's hard to beat that out. Again, like, you'd have to be providing like a -3% to compete with that and have the same sort of market dynamics. I don't see there being enough demand. Likely, the prices just rise on them. Like, that likely is going to be in the case as they depeg, and they just become more expensive for some sort of decentralization.
Yeah, I'm just thinking back to our first interview, Kit, when we were talking to Seba and how he discovered Frax. And he discovered Frax on Aave because it had the most attractive interest rate.
Yep.
And
Right.
so, and that was because of the AMOs.
Case.
Yeah. The most wholesome use case. Finding actual utility.
Yeah. I just want to pay less
I mean,
interest.
and so how do you lower your interest rate even further if the collateral is like useless? And I don't see that happening. There's not enough people that care enough. There will be, I guarantee there's a good bit of people that just have lost their private keys, so they'll have some collateral in there forever.
Many such cases.
Yeah, I mean, I've lost a wallet or two over time, I'm sure. But yeah, I don't know if that's really sustainable for them. And there will be some demand for decentralization. The question is, I actually can completely see this happening. They will have to ask themselves whether they put in a negative rate that forces people to decide whether decentralization is actually worth paying money for that kind of safety. Because it's essentially just like holding. Here's what it'll be. It will be like holding a position on any of these maker protocols plus insurance at the same time. So that will end up being likely the exact cost. It's like you're essentially just insuring yourself from decentralization risks by paying some sort of negative yield on liquidity or elsewhere.
Yeah.
Cool.
Kit, did you have a question?
Yeah, I actually wanted to circle back to fixed rates here for a sec. And obviously, we've seen all the projects that come out from Pendle to Notion to Element. And maybe it's just because, full disclosure, I am not very up to date on the fixed income, fixed yield side of DeFi. But I felt like
it's like this whole subset of DeFi.
Yes, it's
not many people care about
super
yet,
brain.
like...
It's massive. Like when you compare it to TradFi, this is where everything is built on, right? Interest rate swaps, CDSs are like the tits. But in DeFi right now, I don't know if it's because the product is too complicated or whatnot, but I've yet to see real adoption. Or if there is an adoption, you see the TVL chart goes like this, and then it goes like this. So
that's not real adoption, right? So I know you're calling out a specific protocol with that, all right? Yeah, like there's a few of these cases. One got hit like really bad. I'd say the interest rate swap market in particular, which is the design that most of them are built around, leads to really shitty market dynamics that, I mean, obviously I'm biased, but us at Swivel, we're the only ones that have properly addressed at this point. In that, I mean, an interest rate derivative is what it's in the fucking name. It's a derivative. And pricing derivatives on an AMM is prohibitively difficult, right? And the comparison is usually options. On an options market, you're stuck dealing with volatility. You're stuck dealing with the current price. You're stuck dealing just everything that's in Black-Scholes. And with rate derivatives, it's actually very close to the same formula in many ways. And unfortunately, the only thing that, like you mentioned, Pendle, Element, AP, like all of those guys deal with is time passing. So like as time passes, it makes sure that the LPs don't get screwed. But in reality, that is not a major factor when you talk about pricing these derivatives. What matters more is like, what is the current rate on Aave right now? If Aave is paying 5%, well, the fixed rate should be close to 5%. And if the rate on Aave then drops to 1%, if you are still stuck on your AMM quoting 5%, you're leaving yourself open to massive amounts of toxic flow. And this is exactly what happened on, I mean, Element, they opened up a market The earn rate was 5%. Their LPs came in, deposited millions, and they farmed their token, and like that token was what it was. And then over the course of the market, the rate dropped to about 0.8%, and the LPs ate all of those losses. And further than that, you could advertise this as an impermanent loss, but these instruments mature, right? How can you say it's impermanent loss when literally like your loss is locked in? So this is kind of prevented
permanent loss.
Yeah,
permanent loss.
Guaranteed permanent loss. There you go. And not a single protocol actually gives a shit about this right now. The solution right now is token incentives. We'll see if there are more advanced AMMs in the future. For now, at Swivel, we use an order book. Not because, I do think order books have some advantages, but not necessarily for the advantages, but because you can avoid those issues, which is more of the...
Wait, so Swivel uses an order book, but Illuminate
Yes.
uses an AMM. Two questions. Why did you choose an AMM for Illuminate? And like, what are the differences between like Swivel and Illuminate?
Yeah. So I'd say there's like multiple layers to the fixed rate space, as there are in every ecosystem at this point. There's the core protocols that have some unique mechanism and drive yield. And then there are aggregators that live on top of that and end up really being who drive things in the wider space, right? If you're looking for integrations, especially with, let's say, any options protocols, this doesn't really work right now. And the same thing can be said with fixed rate protocols. So on Swivel's end, we use an order book because of these issues fundamentally with the mechanics. However, an order book does not allow you to be integrated with anybody. And these issues don't necessarily exist if you talk about a wider market. They more exist when you talk about like, oh, this isn't a rate derivative of Aave directly. So what we ended up leading to is over time, we realized that there were about 10 different protocols that started working in the fixed rate space. We are differentiated, but this does not mean that the space is growing as it needs to. As you guys implied already, there's a lot of things that kind of prevent proliferation. And I'll get into that separately, I suppose. But the thing that can really solve these issues is, at the end of the day, providing one interface that kind of combines the liquidity of these protocols. And that is what we're doing then at Illuminate. Yeah.
I want to actually touch on that. Like, what are the issues you see with, why haven't DeFi, these like fixed rates and, these interest rates markets, why haven't they been widely adopted yet?
Well, again, I think you have to talk for specific user groups. And I'll talk just like what was the story initially that grew Uniswap? It was not users using Uniswap. I will tell you that. Okay. It was SushiSwap launching and there being arbitrage between the two. And it was there being massive amounts of centralized exchanges to arbitrage Uniswap against. So,
and I would also say DeFi summer and the fact that you had these yield farms and whatnot, and that you had to go, and the only venue to trade these new food tokens was Uniswap, played a lot into it.
Yeah.
And also, and it was a great product, honestly. Like, just using it for the first time, I'm like, oh my, it was just, I don't have to like go in, sign to an exchange, like wait,
it's all there. And
it's
it
all
looks
there.
good too, right? Like,
they knocked it out of the park. Yeah.
Everyone copies their UI for a reason, right? Like before that, there was Shapeshift and Ether Delta. I don't know if you were around for Ether Delta.
Right,
but
Ether Delta.
I was around
baby.
for Ether Delta. Yeah.
Best UI in the game.
Yeah, it was fun. Let's put it that way.
It was terrifying. I was like, there's all my coins.
I actually really didn't understand everything at the time either. So you're just kind of hoping transactions went through. But I digress. Yeah, there was a big differentiator. And there was always going to be volume on Uniswap because there was always going to be price disparity between Uniswap and a centralized exchange. Even before all of DeFi summer, there was always going to be people there. That cannot happen right now in fixed rates because there's no such thing as price discovery. There's no such thing as a wider ecosystem. There's no such thing as rate traders or arbitrage. What you have instead are everybody has different maturity dates. So for during the merge initially, half of the people matured before the merge, half afterwards. This meant that you can't trade rates between the two. Half of them use slightly different mechanisms, so you can't trade rates between the two. And there's honestly too thin liquidity across a lot of these protocols to utilize as a trader. If you are a retail, it's an easy story, right? Like there's just too many of them. Screw that, right? Like that's honestly very simple. But the most important one then comes down to integrators. If you are, an example is Contango. I doubt you guys know these guys because they're brand new.
No.
But they're the only expirable futures protocol. Expirable futures do about 8 to 10% of perps on centralized exchanges. So there's some validated market there. And the core of their product is actually routing all of this liquidity through fixed rates to essentially create this expirable position. Difficulty being is that means that their infrastructure is completely bottlenecked by the liquidity available on yield protocol right now, which is about $1 million. Right. So how can you as a builder, like they raised like $5 million, they cannot scale because they're screwed right now. They have no really scalable liquidity to build against. And like that, they're one of our essentially launch partners. We need secondary liquidity to borrow our principal token, but like they need us to scale.
So the primary problem here, compared to like Uniswap, it's an AMM, but they have arbitrageurs arbing against centralized exchanges even before DeFi summer. Then Sushi came along, people arbing against Sushi. There's really no place to arb and no market that has formed yet for these interest rate markets.
Yeah, there's nothing there. And because of that, liquidity has suffered. And also like there's individual protocol liquidity issues too. And obviously that prevents individual protocols like Contango from growing and utilizing fixed yields as they should. But there's
Is there a way
also
yeah, go ahead. Go ahead, then I'll have my question.
I mean, I've got a lot. So
yeah, I was gonna say, like, does Illuminate solve that with like what you're trying to build? Like, do you like at the beginning, like you set the foundation for a market to take place, and then
have like what I'm most pumped about. Yeah.
Okay.
There's like we combine the liquidity of every single fixed rate protocol, so that Contango, instead of now being completely bottlenecked by yield protocol, can now actually scale, can access the liquidity across every like notional across everybody, and like have a liquid infrastructure to build upon, right? Before our launch, there legitimately is no way to build on fixed yields. Yeah, go for it, man.
Question. I actually LP'd into Element kind of like a year or a year and a half ago, and to my understanding, it was you take the principal token and then you take the base asset, let's call it ETH, and then principal token ETH or USDC for a better example, and then you kind of let people trade against it, and that's kind of where the fixed rate is derived from, right? Whatever the difference is between the trading pair. But if you were to just hold this LP position until expiration or maturity, rather, you are made whole. Like you could redeem it $1 for $1. Your one USDC principal token is equal to that $1 USDC that you had deposited.
It depends. That's misleading. They are misleading, and so if you had acquired those tokens externally and perfectly priced them, correct. The difficulty is
you minted principal tokens and then you LP the principal token with the USDC. Is that what you mean by perfectly?
To an extent, like if you buy principal tokens from the market and then LP with them, you're not necessarily always whole. Like you're technically made whole because you get your initial dollars back, but that's not necessarily whole in terms of I could have just purchased a fixed rate at this price, if that makes sense.
I understand, but if you didn't buy the principal tokens and you minted them instead, right, and then you held them all the way until expiration, then did you get what was promised, or does the issue still occur?
The issue exists always in terms of capturing a sort of cost benefit there, the cost opportunity, because they can frame it in terms of face value, but you're always risking the fact that you are going to be eating this toxic flow. And like if you could, let's say, move your order from 5% to 1%, You just avoid all of that, and it increases your LP. Like you actually profit, if that makes sense, right? So it is legitimate losses being caused by the design of the AMM. While you might like technically not have a negative P&L, your P&L is otherwise guaranteed, and you're losing it, right? So that is like a loss, if that makes sense.
So it's more like the opportunity gain, right? The opportunity cost, because you could have earned this
Yeah,
5% elsewhere instead of this 1.
Yeah, and when they're telling you 5%, and like it's just a lot of it is inaccurate, is what I'd say, and misleading. It's not like they're bad guys, and it's like all lies is the way I'd phrase it, right? Like
It's nuanced.
Yeah. Like, and like that's, I get why they don't go into this detail and say, hey, there's risks. Hey, our AMM isn't the most efficient. Hey, we're improving it. You don't want to tell people that.
We're working on it.
Yeah.
So
you know what it sounds? Go ahead, Kit.
Yeah. Let me finish this train of thought here. So is this AMM model design similar across the board over at Notional, Pendo, and all the fixed yield?
Yes, it's less bad. Like, so there's some realizations that I've made over time, which is that all fixed yields are a derivative of the floating yield because they're just less liquid. That said, notional and element are notional and yield are slightly different in that they have their own yield generation mechanisms. With fixed rate borrowing, you just mint the principal tokens and sell them, instead of using the yield splitting dynamic where you're like, yeah, you have your principal token and yield token. So with yield tokenization, it is very strictly a derivative. Like the yield token, its value is like some derivative value of the floating rate.
What's the floating
and
rate?
that does get like at the variable rate on like Aave or wherever, right? Yeah. And with notional and yield, they have like this separate mechanism where over time, theoretically, in an efficient market, they should be arbitraged down, and they are also a derivative. But honestly, that just hasn't played out. Like DeFi's markets are just not efficient right now. So,
you know what this sounds like? With you're talking about Contango, they raised $5 million. You're an aggregator for like 10 different fixed rate protocols. They talk about product market fit. It sounds like market product fit. Like it's just like all these like fixed rate. It's a great idea. It's exciting. Let's like raise money for it. And now you have like 10, 50 different protocols, but the problem is there's no liquidity for them to trade yet.
Some of it's my fault. And this is maybe sucking my own dick a little bit more than I'm intending to. I came out with the whole yield tokenization thing. And like, as it was a hackathon project, and my background previously was I have a degree in psychology, and I played League of Legends and Heroes of the Storm professionally. It's like, that's my background.
Wait, really?
And yeah. So like, I essentially had to open source everything very early. And I don't think that people were just copying me. That's not what I'm implying. I just think there's likely a lot of work in the same market at the same time, parallel work. But this has definitely contributed at least partially to there being like 10 different yield splitting protocols now. Contango, I feel like they can scale. Like they know the fixed rate will scale, right? Fixed rate space will scale. It just isn't there right now for them. And honestly, their UI sucks. They're really early. Like they don't need it to scale yet. They need time anyway themselves.
Yeah, this kind of reminds like every product has its time. This reminds me of with Gelato, like when they tackled automation. Ethereum had been around for like a few years, but there was really no case for automation. Like the only thing was like Ethereum alarm clock and like, let me send this transaction at this time. But later, once DeFi became a thing, and then once, different,
once people found out that you should create like solid models around rebalancing, essentially, right? Like that's
necessary. One of Gelato's biggest use cases in 2021 was with all the algo stables on Phantom, like all the tomb forks, they all use Gelato.
That's awesome.
Yeah. And so like the time will come. It's just like a matter of timing. Like how, like, I don't think, with these decentralized stablecoins like Frax and others, I don't think they would be around without Curve.
Yeah.
Because like Curve is like the central foundational market for all of them to trade.
Well, like before Curve, there wasn't really significant external liquidity provision interactions, right? It was like all within a protocol. So yeah, like Frax plays this game best. Frax has literally been the winner of the curve game, right? So most definitely, I
Yeah.
think that would have been impactful. Um,
Yeah.
I'd
I mean, I
say
could.
Sorry, go on.
I no, you go first.
Nothing. I was gonna kind of swap topics because we're on
Mm-hmm.
Contango and talking about integrations.
Mm-hmm.
I'd say probably the one other thing that I'm most excited about is options. Not like, and I mean obviously in general. Actually, let me ask that question: Are you guys very opinionated? Are like any options protocols you actually think are worth checking out? You know, like have
Yeah.
you guys used options in the space yourself?
Um, I haven't used options personally, but I have looked
Yeah.
into the topic a lot because I see there an opportunity to be a lot of growth.
Yeah.
Some option, we had the Gamma Swap guys on several months ago, and they're doing something really interesting. And options are just like a whole different thing in itself to like understand it all. I really like the Panoptic guys and like what they're
Yeah.
doing with Uniswap V3. I think is really cool, and how like the background are physics majors. I'm an investor in Panoptic, so I'm biased.
Oh well, that's cheap.
But
Well, I had before they invested around, I had Guillaume come on for Gitcoin Kernel. I also like lead
oh,
the DeFi
cool.
stuff for Gitcoin Kernel, so he came on
Oh,
and
sick.
chatted with us. Yeah.
Yeah, no, I originally heard about Panoptic from my friends at Arrakis, and like a way to hedge concentrated liquidity positions was with with managing them was with something like Panoptic. So that's how I initially heard of them, and then I met the team, and I'm like, oh, this is like really cool. So I think like options, I'm excited about the opportunity that's in options. I think that's an area for a lot of growth. Um,
So, do you
mhm.
have like, is there any reason why they suck today?
um, any reason?
Liquidity? Yeah, like
Yeah,
I feel I've generally
yeah,
had conversations where people are very interested in the option space growing. There's been like some decent growth, but there hasn't really
yeah,
been anything that kind of pushes them forward yet, right? Um,
yeah.
Mm-hmm.
I don't know.
Yeah, and
I'm kind of
also
like, sorry, go on.
Sega sounds interesting with their exotic options. Um,
I'm not
I
familiar.
Sega, yeah. So they were originally on Solana,
Okay.
and they're moving to Ethereum, and so it sounds. Uh, I have to look into it more for me to like speak about it
Yeah,
confidently.
yeah, that's fair.
But yeah, so um, also Kit's where did Kit go? Kit's back. Yeah, let's just roll.
Yeah, like options are very difficult to provide liquidity to. It seems like a lot of the volume comes from arbitraging them with the centralized venue, which is why I mean I'm very opinionated. I think that
Hmm.
I'm amazed that there hasn't really been an RFQ platform yet launched. I think Premia is doing that with their next version.
Hmm.
The only RFQ option is so Gamma Swap. You're referring to the open product, right?
Is
Maybe.
that?
I
I
think
guess
No,
I
that
think
I
they
think it's a
renamed it
different.
to Gamma Swap.
They basically built an inverted V2 Uniswap V2, so it's not in permanent loss;
Okay,
it's in
okay,
permanent gain. That's
okay.
from what
Interesting.
that's how I understand it. They have in
So
permanent
I need
gain.
to look
Yeah,
in that now too, because I
yeah.
think that it was probably not Gamma Swap. It's like Gamma something is what Open renamed their V2 to, which they
Oh,
previously were the only RFQ infrastructure. It's like open, but not very open. You can only do USDC, WETH,
Mm-hmm.
and USDC Bitcoin options. Um, so in my mind, there does just need to be RFQ and then people arbitraging a centralized exchange. And let
yeah.
me actually circle back to why I'm even bringing this up. So options, I think, are like in general that there's an advantage in DeFi to maturing instruments, in that you can take any two instruments that mature and guarantee that they actually mature at the exact same time, the exact same block, exact same everything. And in doing so, you can actually rehypothecate way more than you could ever potentially in any other context. So the first example is what we're working on immediately ourselves. We're calling them illuminated options, which are options that are underwritten by principal tokens,
Okay.
where you have a principal token. You know, let's say it's 1,000 principal tokens that mature on December 31st. So on December 31st, you will have $1,000, and you can take that and then underwrite an ETH option at $1,000, let's say, right? And all of a sudden, you're doing something that cannot be replicated on a centralized exchange. You're underwriting an option and you're lending at a fixed rate at the same time, or selling interest rate volatility, depending on the way you look at it.
That's some composability right there.
Yeah, and there's an actual value proposition,
Yeah.
right? Like we're able to, if options sellers are earning 10% and we're able to offer them 3 to 4%, we're increasing their yields by upwards of 40% on their premiums. And if they're earning so much more on this aggregated premium because they get both legs, then whoever's actually buying the option likely gets a discount on their leg as well. So like we're able to give this very strong value proposition to anyone on an decentralized exchange, which is, hey, we're able to pay you upwards of 40% more for your option. You're just getting 40% more premiums. And then the people buying them, they're able to get a discount too.
Wait, can you break down how people are getting 40% more?
Please.
Yeah,
That sounds fascinating.
Yeah, like so let's say today you're able to sell an ETH put like way out of the, or ETH put way out of the money at, $1,000, for example. Yeah. Mm-hmm. So you might only earn, honestly, today, $1,000, you probably only earn 1% or 2% at that, like, because it's way out of the money. Maybe more. I honestly don't know. But let's say you're earning 5%. Well, or let's easier numbers. Let's say you're earning 10% on the option APY, right? That's closer to what Ribbon earns on a regular basis. If then you take that capital that otherwise would be strictly underwriting this option, and you go to Illuminate, and you simply click a button that allows to, instead of directly underwriting the option, you underwrite it with the principal tokens. What effectively happens is the USDC will go in, purchase the principal tokens from Illuminate, which that's one leg you might be earning for. Right now, the rate is actually 5.2%. And then right after that, it goes and it contacts one of our partner market makers, or I mean, we plan to do this ourselves. Maybe Premia just cuts in front of us and we end up partnering with them instead. But contact GSR, CMT, the large options market makers, and they just simply arbitrage you in Deribit. So at that point, you're earning this lending leg and the options leg on chain at the same time. They're very happy to provide this liquidity to you because they actually get to arbitrage and make some significant guaranteed profits themselves, these market makers, looking at your price and Deribit. And everybody at that point is earning a ton more than they otherwise would if they'd just been sitting there using Deribit itself. Again, and I don't really... Yeah, go on.
Just to clarify a little bit here. So you're saying instead of using USDC and underwriting the vault straight out, you actually use, for a lack of a better token, like IUSDC, Illuminate USDC, that is put into a principal token. And then you use that principal token as collateral to underwrite. And then the market maker will totally take that and arbit against whatever the $1,000 put on Deribit. And they just print that all day. Yep. Okay, so where does that?
And they're happy to 4%, do it.
Yeah. For the principal token, where does that come from?
Right now, it comes from every fixed yield protocol. It's originated across all of those different folks. So whoever is providing the best yield at that point in time will essentially be being routed that liquidity. Usually, there's I haven't even gotten into the mechanics, honestly, of Illuminate. Usually that should actually directly be our aggregated principal token rather than anyone externally. And there's a lot of impact from this. Obviously, I do think that it's very attractive. You can give people a hard value proposition. Hey, you just make more money. That should onboard people. But there's just so much more that can be built too.
So let's break down, how does Illuminate work? What are the mechanics that make Illuminate function?
So arbitrage is actually the most important thing. We rely most on external actors. And then the core mechanic is most similar to something like a meta stablecoin. Where do you guys remember DeFi Dollar or MStable?
MStable. Yeah, they shut down recently.
The idea behind most of these folks, and MStable I think's had some other concepts behind it, but one of the core ideas is that you could hold you could mint any stablecoin out of a basket into this meta stablecoin. And the idea is kind of the original thought on diversification. Hey, now you're holding a basket, it should be less risky because if USDT is trash, then at least you have 80% of your capital. And they failed over time because people did perceive that, USDC was lendy, right? But this is far more applicable in in markets where the price isn't actually benchmarked to $1, right? So in this case, the question that needs to be asked is, okay, or rather, let me specifically what the mechanism is. The mechanism effectively allows any external principal token across all of those protocols, Notional, Pendle, Element, Swivel, etc., to be wrapped at a one-to-one basis into this meta stablecoin. And at any given point, the meta stablecoin is backed. It has capital there to be redeemed because it has the external principal tokens. And the question becomes, when does a user take an external principal token and wrap it into the meta one? Why would that ever make sense? And the answer is, well, if you can gain some value from that process. So if at any given point in time, the meta stablecoin trades at a higher price than any external protocol, an arbitrageur comes in, purchases the external principal token, wraps it into the meta stablecoin, and sells it for an immediate profit. And because of this arbitrage process, what ends up happening is at any given point in time, there is a rough equilibrium between whoever has the cheapest principal token and this aggregated meta token, right? Because otherwise it would be being arbitraged down. And this is extremely important. This establishes us not just as an off-chain route of liquidity, but as an interface on-chain that anyone can access, and it gives them an actual guarantee that they get that best rate, right? Arbitrageurs are bringing in liquidity from every protocol to generate that yield for them. And arbitrageurs also are effectively guaranteeing that the meta stablecoin is always benchmarked to the best rate on the market, or the meta principal token. And again, like, it's kind of unique, but also the mechanic itself is very simple. All we do is we wrap principal tokens into our meta principal token. And the rest is like a bunch of cool, more financial workings, I suppose. I don't know.
Yeah. Where do the arbitrageurs come from? Like, how are you going to attract them?
Arbitrage is free. So
yeah, sure.
Right. Yeah. Like, if money is there, people will come.
If you build it, they will come.
When this was our initial point, actually, right? That there was not any way to arbitrage fixed rates until now, right? Mm-hmm. And now there is a way to take the rate on cents and trade it against our principal token. And because of that, there's a way for there to be a wider ecosystem. Same with Notional. We launched on Thursday, and within 12 hours, we were the largest Notional depositor within any 24-hour time frame. Their rate was arbitraged down to our aggregated rate. And then Sense, who had seen like almost nobody deposit to their stablecoin market this month, immediately had their stablecoin fixed rate drop from 8.9% down to 5.5% with the rest of the market. Mm. So like it's
so you're like the first power user.
Yeah, we're the first power user across all these protocols, and all of that is effectively just being driven by this arbitrage that's already happening. So it's really cool. Honestly, it's mostly was theory crafted for months, right? So it's really exciting to actually see happen.
And so I actually want to get into. Go ahead, Kit.
This is so interesting. So that's why I have a ton of questions here. And for the principal token from, say, Project A and principal token from Project B, you take all of these principal tokens in, and then you create the meta principal token, right? And then
correct.
Now, if I were to be, a principal token holder of any of these projects, and I recognize that, like, I could actually wrap my principal token for more because the current yield is higher, right? I could arb that, then I would totally go in there and wrap it, right? So that way I can kind of quote unquote lock in those gains or bring it back in line. And that's kind of how it drives. So after that, after I hold these meta principal tokens, where does the user go from there? I can see the reasoning and the demand for wrapping it, but after that, what else? Do they just sit and hold, or what are you wishing the users do with it?
You sell it. Yeah, like if you're doing the wrapping process directly, you sell it, and then you initiate if you like really just want to hold the position externally, you sell it, make an immediate profit. Let's say if like the Illuminate principal token is trading at 95 cents and Swivel is trading at 93 cents, right? You're a user on Swivel. You already have a bunch of principal tokens. You just wrap them, sell them, and reinitiate your position on Swivel.
Okay.
And this is like very, very profitable for people in there. And the core is like, okay, I might not know that this is the best rate for the rest of the time within this market, right? But I know that this is the best rate right now. And so if the value statement, if you're a lender, is I'm just trying to get the best rate right now, we do guarantee people that value proposition. Right?
Got it.
I was going to ask about your collaboration with Frax and what you're doing with FrxETH a bit more. Can you go into detail about that collaboration?
Yeah, there's a few things directly. Like the first step starts with Swivel, but there's also other protocols that have been getting into the Frax ecosystem, which make things a lot more fun and reasonable for us to start getting an aggregation too. So first and foremost, right, we are launching a staked FrxETH market on Swivel to provide Frax stakers with a fixed rate option, I believe tomorrow.
Oh, wow.
Devs, yeah, I believe tomorrow. We don't have an article ready for it yet, so like the fanfare will likely come around Thursday. But like, I believe the tech side is done tomorrow. And that in itself will provide people with a pretty attractive fixed stake yield, right? This is very important to provide people alternate options rather than just something volatile. Very simple. However, I think there's a lot more we can do in terms of pushing the yield. The advantage that Frax has is they're onboarding people that are just trying to get, I think it's like honestly about 30% increase over Lido at the moment. And targeting that market and boosting those yields will continue to onboard people. So something that we had previously planned, very hard plans with Euler and Frax with, was a tandem market that allows people to get a fixed yield, not just on the staking leg, but on the lending leg at the same time. And we're likely trying to boost this with Silo at the moment, because of ongoing Euler issues. And similarly, at the end of the day, the goal is to then push the staking yield to above 10%. I think it's personally much more attractive to stake at around 10% than kind of accept 4.5% variable on Lido. So that's kind of honestly a larger market we're targeting beyond just staked FrxETH, but staking in general.
Could you use FraxLend to build these types of products as well?
I haven't talked to Sam in a couple months. I am very confused why they're not confused, because it makes sense if the goal is to try to just push Frax itself. I'm confused why there isn't a FrxETH FraxLend market. And let me clarify. I don't mean like put up FrxETH as collateral and then borrow Frax with it. I want to borrow FrxETH and I want to borrow ETH, or like essentially just have a more liquid market that allows there to be yield generation itself for that staked FrxETH.
I don't think it's been proposed yet, to be honest.
It's probably on me. I'm going to be honest. I've just had my hands full. Yeah, go for it.
Just to hop in. I've talked about this multiple.
You're real quiet.
This is better. I've talked about this multiple times with Sam. I brought it up in chat, and I think the general consensus right now is that it's still early, and when you start allowing like that amount of leverage to enter the system, right? Because in theory, you would probably be able to get up to 10x or maybe 15x leverage, depending on where they set the LTVs. I think there's a little bit of trepidation in thinking, what would happen if a big liquidation occurred, right? What if we had to unwind quickly, right? And we have all this, we have this big liquidation that's going through curve. It pushes the peg off, and then something happens. But that's just my 2 cents. I'll let you guys discuss.
I'm interested actually in that point of view, because I think that's as a liquidity provider, if that happens, I'm pumped, right?
Because you're just earning more fees.
Yeah, or even let's say if I'm a big fan of FrxETH, then I exit my LP and I've essentially just bought them at a discount. Like I get it actually, because at the end of the day, a lot of people have historically looked at like this 1-to-1 peg and seen, hey, is this reliable enough for me to put my money in? God, I I'm one of the winners. Slash, I didn't actually mind all of the staked ETH DPEGs. I just was like buying them, so maybe I'm not the best person to like kind of consider that, I suppose. But that was the same concern, though. I'll say, like, we talked with Silo recently. That was the same concern they had. Not necessarily was the peg, but was like the liquidation routes and the like reliability of the Oracle as well.
Yeah.
Like there is still no Chainlink Oracle available, so I believe there's like, I haven't. They asked the Frax team what they were doing for Frax Lend and how they're liquidating staked FrxETH. So there is an answer there. I just haven't read it yet. But yeah,
it might be. I'm not sure what it is yet. But anyways, outside of FrxETH, you mentioned you're building Frax markets as well. Can you go into that?
Yeah, and I think there is reasonable opportunity for aggregation. Right. So staked FrxETH, Pendle has a market, Illuminate has a market. Or rather, Swivel has a market. We're actually also, I'll just really quick show for this. For our ambassador program, we also included staked FrxETH. For our ambassadors, we rewarded everybody with a long position on Swivel itself. So you've essentially taken a fixed rate, and within a certain number of days, you can actually redeem it. So that's all backed by staked FrxETH as well. But as far as aggregation goes in the wider ecosystem, there is a massive opportunity for Frax to participate here, because there are already markets live. Staked FrxETH will continue to get markets live because it does strictly offer the best yield, even above Aura or any other LP programs. And then Frax itself can continue to be proliferated. It's already up on yield. We would be launching a market on Swivel. The big question is just liquidity there, right? Mm-hmm. So I think this does come down more to governance and launching gauges for these other projects, right? Mm-hmm. But there is this massive opportunity to gauge in fixed yields. There's nobody else that's really significantly providing liquidity. Even let's say a 10 million commitment and like getting 10 million into fixed yields would all of a sudden mean that Frax is a dominant figure in the space. Mm-hmm. And if there is to be this wider growth from all of the stories I'm talking about, establishing oneself is obviously very beneficial. So yeah, there's a window here. There's already markets live. It just kind of requires there to be some incentivization and a little bit more built out. And all of a sudden
you add velocity to the flywheel.
Yeah, it becomes massive. If there's one of the main points I do try to make with Illuminate is that we are already starting to own every single piece of the liquidity stack other than strictly swaps, right? When you talk about lending and borrowing, this is strictly, we're aggregating all fixed rate lending and borrowing. We're aggregating staking. We are aggregating and serving as, there's no real reason why you should look at options in the next couple of years and not get additional yield on it. We have these partnerships in place. You can look at expirable futures. Essentially, every single financial instrument other than Uniswap, right, can begin to be covered by fixed yields. And it obviously at that point, there is some large incentive to participate early and ensure that you are part of that core of the ecosystem for sure.
What happens if you participate early?
I don't know. There's no guarantee of the token, okay, right? What I would say is that anytime you have an ecosystem that is this wide and large, and anytime there are efforts that require the coordination of multiple parties, you end up with a token in place. So there's no plans for a token right now, right? Being strictly clear about that. But there is some inevitability in terms of the design and direction we're going, and that there will need to be arbitration processes, right? If we're the only ones that anyone is ever integrating with, how do we decide what principal tokens are acceptable within the aggregated basket, right? This can't be done by me, because right now it would just be like me. Yeah, that's what I'd say there. Yeah, wink, wink, provide liquidity, no guarantee of anything, right? But it's obviously very beneficial. And, at this point, the yields are decent. The yields are about, when you enter the position, you get about 5% on the principal token leg, and then the provision of liquidity is about 8% in addition to that.
Nice. A nice, solid,
Could you
reliable
walk
yield.
us through a little bit of that? How
Yeah.
does one provide liquidity on Illuminate?
Well, honestly, we've made it very simple. We're making it even more simple with an upcoming auto roller release. But you literally just go, you choose the market. Right now, there's literally only one market live. It's just USDC that matures in July. And it effectively, we provide a convenience method that purchases principal tokens precisely to the exact amount that you need, and then immediately provides liquidity to them. So you can do this in one button. If you want to do it most effectively, you go to the UI, you lend a bunch of capital, however much you think you might need, and then you go and
Taking notes. Taking notes. Okay.
Got it. So if I had like 100 USDC, I go to Illuminate. There's a one-click button that would then purchase,
you go to pool
X% of PT, and then I would have 1 minus X of the USDC, and then I will put it together into the pool.
It does it. It all does that in one transaction, so you don't even have to worry. Yeah.
Beautiful.
I'm wondering what cross-chain stuff Illuminate has planned in the future, because we live in a multi-chain world. We have L2s, BSC, BNB chain still dominates. Matic has a ton of traction, and other ones as well. How does Illuminate fit into this cross-chain world?
Yeah, difficultly at first, right? I'd say there's a few steps to this. One, like Swivel immediately, our next version is going cross-chain. We need to focus on staking products, and this includes BNB, Matic, AVAX, wherever, really. And
are you guys going to be on Barachain?
Yeah, probably.
Yeah.
Like one of the value propositions that Illuminate or like Swivel has is specifically for the Cosmos zone, there will be significant volatility surrounding these staking products because, let's say DYDX just has a bunch of market volatility one day. All of a sudden, there's like 80x demand to trade on their platform. And obviously block space within their Cosmos zone is going to be more expensive. So stuff like that is interesting. But there's growth within the staking derivatives on all these chains. And then there just needs to be, honestly, my biggest thought is wider growth of layer 2s. And obviously people have been saying this for a long time. But the only takeaway I could really have from the Euler hack is that there needs to be further fail-safes put in place for every protocol. And honestly, these are not viable on layer 1. You can't we have one layer of rate limiting on Illuminate, but you can't rate limit every individual integration. You can't rate limit every single currency. You can't add in a ton of circuit breakers. You can't modulize all your custody. Essentially, there's a bunch you can build that just doesn't work. And I don't know, as an integrator, it is very difficult to swallow the fact that Euler got hacked, right? Every single heuristic that was available for the safety of a protocol essentially had been passed. They had reached 500 million previously. They weren't at their highest peak currently, right? So it's not like there was the max loss. They had gone through a bajillion audits. They have a large bug bounty, essentially everything possible. And so this really does just leave the conclusion that you need to push a bunch of liquidity to layer 2. So on Illuminate, we will likely be AESAP going to layer 2 and essentially working with teams that are doing this. There's a money market that we're working with. It's actually one of the guys from from Rari are relaunching it with variants and a lot more control. One of the things being control of the rate limiting of your pool, which that sounds good to me.
So how do we encourage more liquidity to layer 2? Because I see this as a necessary one-way path for DeFi to take, and that that people want to see. But how do we get there?
That's a good question. As of right now, there hasn't really been anything that has proven to work, is what I'd say. The only thing that has actually worked is GMX growing, and then people building products that build on GMX.
I say GMX has the perfect product market fit, honestly. They
Yeah.
really hit it out of the park at the perfect time. Literally like the BitMEX of this bear market.
And I wasn't even like, I'm not even a fan, but like they did do a great job. The reason I'm not a fan, I didn't buy. I never bought.
Salty,
but
culprit.
yeah, exactly. Because it's just like it was another perp market at first. That's the first look at it. And
But it wasn't another pro market.
well, and also I think they bring up the importance of advertising.
Like
I will
the
even
referral links. Yeah.
Yeah, and Pendle I will call out as reforming their protocol, and they didn't actually change anything about the protocol. They just changed the way they're marketing, and all of a sudden they're relevant, and it kind of was weird. So like,
I mean, that's all it takes is like a change in messaging.
yeah, they went from calling it fixed rate lending to calling it buying assets at a discount. So now, like, if you want GMX, you go to Pendle and you buy it at a discount.
At a discount.
Yeah.
Some words of wisdom, words of advice for people and builders out there. Make it sound simple. Yeah.
Yeah. That's
Direct.
where I fucked up a lot of the time. So again,
where else do you think you fucked up?
Business development is most difficult, I'd say, right?
I know. As a professional in that area, it's hard because it's soft skills and trying to like, being able to be a social organ for an advanced product, whether it's in DeFi, whether it's in infrastructure, and having proper reach out, and knowing who you're reaching out to, whether it's like a retail user base or like different customers or different protocols. It's hard.
Yeah, it's hard. I think it's probably the most difficult job to find real talent in DeFi.
Yes.
I've been able to onboard and I've talked to other founders. They've had problems with their dev team, so maybe not. But our dev team has always been amazing. It's just so much more difficult to really, really find people that are going to do everything, right? Like I need a mini me, and that's never going to happen. But beyond that, where have I really fucked up? I think mistakes have come down to choices of integrations and timing of things, right? Like we raised at bad times, we launched at a bad time, right? And this has really hurt our growth as things have kind of progressed over time, stuff like that. And then like spending a bunch of time last year getting ready to prepare to launch to Arbitrum with Rari, and then that happening with Rari, and then like spending a bunch of time preparing and partnering with Euler and everything, and like we'll see where that goes. These have honestly
third time's a charm. Third time's a charm.
These things have kind of killed us to an extent. We were pushing really hard for this layer 2 launch last year, and shit, we would have gotten a lot of tokens for that too. Now that I think about it, so it's double screwed us. But these mistakes can happen. I think they are just natural. And I think, we luckily, our marketing team, you got Big D and Wartooth and everybody and Bones around, right? Like,
you have a great team. You do have an all-star team around that. So, you guys done a good job there.
Yeah, and it's working out at least at first now, right? Like the Illuminate message and story is much bigger than Swivels. We are owning so much infrastructure, and it does require a lot more help when it comes to actually coordinating everything.
Yeah. So what does the roadmap look like for Illuminate in the coming months?
Yeah. So immediately the goal, we're in a guarded launch right now. It's only $200,000 a day that even can be deposited. So we're slowly rolling that off. The goal is to kind of hit a threshold of liquidity, right? The most important thing for the fixed rate space, not even just us, but is us hitting, let's say, $5 to $10 million, somewhere in that range. So that there can be products built and all of these stories that I'm saying can really come true. So like our core focus immediately is purely acquiring this minimal amount of liquidity that can validate, let's say, Maker deploying significant liquidity or Yearn deploying significant liquidity. And I mean, I'll actually specifically talk about this because it's a little bit interesting, and I'll get back to the roadmap. I won't forget. But is that these parties have very topical issues. They essentially would love to deploy capital to fixed rates. In fact, fixed rates are beating out whatever rates can be offered right now. So it even just of course, it makes sense for them. The issue is that they are essentially banks. right? Yearn, Maker, etc. They have to deal with the fact that at some point there could be a bank run on their protocol. And like SVB, like Credit Suisse, if they're stuck holding a bunch of principal tokens and 50% of their TVL is lost overnight, they have to sell those principal tokens potentially at a loss. And there needs to be liquidity there to sell against, right? So they are very restricted, but there is very easy targets for us to hit, right? For every certain amount of liquidity, we can guarantee that these entities will be deploying even further. That's immediate roadmap, is just to make sure that that can all happen. Immediately after that, we're launching our auto roller product. So essentially, we need to make sure that whatever liquidity we do get in can be sticky and stay there forever without people needing to manage it. And then ASAP, there's two things. There's the launch of Swivel v4, which is the stacked FrxETH and Euler silo product, and this focus on staking and cross-chain interactions. And immediately following that, of course, we've got kind of a lot going on here. Immediately after that, we have the options, which obviously is pretty exciting.
Big opportunity.
We're trying to onboard user groups that haven't really been onboarded. Like there's lenders that want higher yields, and then there's options underwriters that just want more premiums. So there's kind of different people there for us to touch upon for sure.
So this is one of Kit's favorite questions, but what does success look like for Illuminate?
Man, one of our investors said this, and I agree. We're not aiming to be like $1 billion protocol, right? This is like we're trying to be like a $10 billion protocol, or more. This is a product that has the opportunity to push not just fixed rates forward, but the option space, that was why I asked all those questions about why options suck, because I needed to get you guys to say, hey, options suck, can push that forward. Expirables, like all of these things, right? They are hamstrung right now, and success for me means that they actually exist. That's like, in my mind, fixed rates just strictly do not exist within a couple of years as these projects run out of capital if we don't launch successfully. Expirables, very clearly, they are completely bottlenecked by our liquidity. They won't exist. Options, Panoptic is doing some cool stuff. Maybe that can exist in a vacuum, but I don't see still any reason for many people to trade on chain most options, other than if they're like worried about jurisdictional stuff, there's a reason there. There's reasons. But yeah, that's success for me, is like actually winning and making all this stuff actually happen.
Got it. And then on the counter side of that, Julian, what are some of the biggest risks you see today? What's keeping you up at night?
Oh man, people, like, yeah, to an extent. Like, I was gonna say the Euler stuff and these upgradable contracts, essentially the risks surrounding all these integrations, but it's been clear at this point that, I've been here since the start of DeFi. I've never actually lost money in a hack. All that I've been hit by was Euler. All that money should be returned. Rari, all that money should be returned. But both of those have issues with people. Very clearly, is like, that's the kind of the friction there.
The layer zero.
Yeah, and then the last one was Sherlock, where I deposited money in Sherlock, and then they had deposited money in Maple, and Maple had given all that money to Orthogonal. So that's very clearly a people issue too. I just don't know if I trust most of our partners anymore, which sucks. That means I need rate limiting in code, because like,
trust the code, not people.
Yeah, precisely. Trust the code, not me. Trust the code, not me.
Yeah, trust code, not people. That's it. Kit, did you have any other questions, or should we get to the fire round?
Let's get to the fire round. So,
Julian, lightning round or fire round?
It's a lightning round. Fire seems scary, but no, it's just
Right.
a series of questions that
I'm
Dave and
clipping
I
burned
like
onto
to.
the coals.
Nah, we're good. We're good. We like you. We like the swivel. We like the Julian. So at the end of these, we like to ask a series of lightning round questions just to get to know the human behind the builder. The man
The
behind the
person.
legend. Yes. So Julian, first question for me is: when did you first touch the blockchain? What was your virgin crypto experience? And sex don't count.
Interesting. Man, I'm assuming using anything on chain doesn't count, or rather off chain doesn't count, like a centralized exchange.
Correct.
So my first actual experience was getting scammed using a Bitcoin mixer in like 2016.
Whoa.
Yeah.
Okay.
I was
That's
trying
a good one. That's a good one.
Tumble safely.
I had no money. It wasn't all my money either. It was like $100 was mine and $300 was other people, and I had to lie to them and tell them that it had been lost, and like it was just like something with like it's coming.
They're gonna come after you
Boating
now.
accident.
Yeah,
Boating
that's-
accident.
Essentially,
accident.
I had to make the money up over the course of a couple weeks to like because I couldn't let them know that like they were finally trusting crypto and me and like all this, and then I literally just lost their money in a Bitcoin mixer. It was like a fake mixer, fake link.
Rugged.
Yeah.
Okay, very fun. Second question is: what is your favorite off-chain touch grass activity? What are some of your hobbies and interests?
Ooh, does touching grass mean only outside or like?
No. Hobbies and
When
interests.
you see the piano back there.
Oh
Yeah.
yeah. I mean, I've got these. At this point, I consider myself more of a collector than musician because I don't know. I just don't find time for it. I'd say I spend the most time outside of building playing games. I mentioned it earlier. I used to play games professionally. These days, I play Overwatch. I just got to Grandmaster 1 actually, so I'm almost into the top
Nice.
500. We're
Oh.
almost there.
Wow.
It's surprising to most people that in any other industry, I don't think that would get me much. In this one, it gets me some clout. So
Yeah, my brother is
Yeah.
actually also close to that level.
yeah, it's close, man. It's like
Yeah.
I don't know. It's a little bit too sweaty for me to go to that next one. I think we'll see.
Yeah.
So Julian, what would be some advice to your younger self?
Ooh, play less Overwatch. Probably. No, like just take things one day at a time. I think this is something very important for most crypto founders in general, is that people get very overwhelmed with everything that's facing them. When at the end of the day, you're not going to be a crypto founder unless you are the person that just lives and does this anyway, right?
Mhm.
So when you start to just take things one day at a time, you just end up doing all the work. It just ends up getting done. Assuming you're the responsible person to begin with, I suppose, right? And that's really important. A lot of people that I've met, especially early founders, really stress out about like this task didn't get done today. It's fucked. I'm fucked. I'm irresponsible now. Well, like, no, like, just get it all done. The most important thing in crypto is just getting your stuff out there, not at all being perfect. Not like not even anything getting the release date right. And I think this extends down to my developers and not to everybody, and makes working with us actually reasonable and more like a real company, right? I make sure to give us deadlines. It's not the biggest deal if we miss the deadlines, right? Because that's the reality in Web3. You just have to deal with it. And nobody's ever going to get like, I mean, that's not true. If we really got behind, I'd be pissed, but we've never been behind to any extent that I've actually needed to.
Got it. And the last question to close this out here is
Second. I want to second to last, and I have
okay.
another
All right,
question.
second last. Got it.
Okay.
Yeah.
So last one for me, Julian, is if you weren't in crypto, finance, or playing video games professionally, what would you be doing with your career right now?
Man, I was screwed. All right. Like, again, I have a degree in psychology, man. All right. It's so the how I got here was that I had been living in South Carolina paying nothing for rent, and then my mom told me she could get me a job in Maryland. So I moved up to Maryland, and I started the project at the same time, so I haven't gotten a chance to move out, and I've been here ever since. Yeah. So what would I be doing? I'd probably be working in the government doing some really low level bitch work. I live around the DC area. And I'd slowly be trying to work my way up into a relevant position. Previously, I had been applying to like work around crypto regulation, but at the time, crypto regulation wasn't a thing. So,
Timing's everything, like you said.
Yeah. Yeah.
And last question for me: who would you recommend to have on as a podcast guest next?
Ooh. Have you had on Cozy anytime recently from Premia?
Oh, that would be a really good one. I have not, but I'm friends with
You
Cozy.
should. They're dropping a new release, Premia V3 next month.
That'd be perfect.
It touches on some of the stuff I did, like the RFQ for options. That's like one big thing they're building. So if there's any like interest in options there, I think they'd probably be they're probably doing some of the cooler stuff in actual options, not replicated options, if that makes sense.
Yeah. I'm going to see Cozy in Japan, so I'll be like,
you're headed to Japan. When is everyone actually heading out?
A bunch of people are there now, and, I'm heading there tomorrow with a few people.
Okay. Will you be, I assume, not around New York afterwards?
No, I'm doing like a mini world tour, actually.
Okay.
Yeah. There'll be a Alpha. There's going to be where there is, for those listeners in Hong Kong, we're likely to have an event there. So be on the lookout for that.
Well, we'll also, I'm trying to get this together. I don't know how much of the team you guys have in Serbia, but we're getting together ETH Belgrade. So that'll be a thing at some point. Yeah, that'll be a thing at some point.
Oh, wow.
Hell yeah. Yeah.
Awesome.
Sweet. Well, Julian, thank you so much for coming on. Excited to see where Illuminate goes and brightens up DeFi in its own way. Thank you, and we'll see you soon.
Awesome. Thanks for having me on. Enjoy Tokyo.
Hello and welcome to the postgame. I'm Sam, and I'm joined with my two esteemed colleagues, DeFi Dave and Capital K.
And you joined with one more.
We have a special guest.
We have a special guest who's coming along for the show. Can't hear anything, but it's okay. What a cool podcast, guys. Very insightful. I actually learned a lot here. What were your big takeaways?
My biggest takeaway was that in order for a market to form, there needs to be a reason for the market to exist. And that sounds like very basic, but right now, the problem with these like interest rate markets and all these different derivatives is that there's no liquidity and there's no incentive for it to exist on chain as it is. There needs to be a venue for it. The reason why Uniswap took off was because people could arb against the centralized exchange and later Sushi Swap. And so that's a mouthful, Sushi Swap. Anyways, what Illuminate is trying to do is actually create a market for all these different fixed rate protocols, and there just be one location. So once you have enough, accumulate enough liquidity in one location, in theory, arbitrageurs should come and create that market.
Chicken and egg.
Chicken and egg. The classic chicken egg. Yeah. Simple chicken egg problem. Thank you.
So what kind of liquidity do they need? Do they need dollars or ETH or what?
I guess it depends on the market.
I think it's both. As long as there's enough.
Yeah.
His target was like 7 mil, right? Just to get enough proof of concept out there to have arbitrators and market makers excited enough to participate. But one thing I wanted to add to Dave's point earlier was that,
wait, before we jump to your next point, Kate, can I ask one question? Is that AMO that I'm thinking, or is that, am I not right on that?
Oh, I mean,
can Frax provide $7 million for favorable terms from them, much like what what's it did, like Clever did, right? So they provide liquidity for a specific amount of time, and then in return, Frax receives an allocation of tokens.
Oh, that's interesting.
Linearly,
if they have tokens.
If they have tokens, if and when they have tokens, right? If not, then they can just get like fees or something. I don't know.
Interesting.
Anyways, future BD ideas. Keep it in mind. We'll have a chat.
Wait, Julian,
what were you saying? Just nerd sniped me. Sam just nerd sniped me.
I'm sorry.
Give me a second. Let me come back to my thing was Dave said during the call that they had a market product fit, and I really like that because in TradFi, fixed income and fixed yields is like the number one thing. It's like bigger than almost other markets except for the derivatives and forex market. But like, okay, that's the market, right? And then DeFi tries to build this product for it, but yet there are no users kind of demanding it. So it goes back to the
there's no users
problem. Because it's just so damn complicated.
There's more protocols than users. Yeah.
Yes, literally, there are more protocols than users. So in my mind, I was always kind of bearish on that. But this new application of it seems like the unifier across the board, because you can't have 8 different principal tokens. That would be like having 8 different US Treasury bonds that has the same expiry or like 2 days difference expiry, or denoted in, instead of being at $1,000 par, it's like $100 par. Like, it's all these little nuances. It's because of permissionless innovation in crypto that it allows for this, chopped and diced up. But there comes a need for an aggregator to step in and unify everybody. So that's why I think Illuminate is has a clear product market fit, but I just don't know how large that market is today.
And another primitive with market product fit is options. There's like a ton of different options protocols, but none have really taken off in a big way like Uniswap just yet. And so, they realize like, oh, like what we're building, we can actually create this options primitive. And I have to like let that marinate in my head more, how like you can earn like 40% on your premiums. But it just, it sounded interesting, like the different money Legos that could be built on top of. Yeah, go ahead.
Let me just explain to you where that 4% comes from. So normally right now, if you were to underwrite,
was it 40%?
Yeah, it was technically, if you're only earning 10 on your options that you sold for the premium, but if you own another 4% on top of that, that is a 40% bump. But the way you get that 4% is instead of using USDC, you just use an interest-bearing USDC. That's it, and that interest-bearing is 4%. Okay. That's where you got that.
Okay.
Like, imagine using your collateral that earns yield that lets you speculate on top of that or hedge with your options. So that's where you get the extra boost for it to come in. So kind of vanilla there. Does that make sense?
I wonder what the risk. A little bit. Honestly, no. But I'm gonna have to think about it more.
All right, off chain. We'll talk about it off chain.
Off chain. I was thinking about. I mean, what are the risks associated with like stacking derivatives like that?
So for me,
contract risk, right?
Aside from the crypto side of stuff, for me, I feel you're only as strong as your weakest link in the basket. Because yes, even though one principal token can go bust and then all the basket is still okay, but you're now say down like 5% or 10% of what is supposed to be $1, now it's 95. And that's the tricky thing with targeting the stablecoin market, right? Is that there's no, like it's not a spectrum, it's 0 or 1. Like you have to be $1. If you're not $1, you're not $1. So that's the kind of like the razor sharp edge that stablecoin protocols have to deal with. And it's just that much harder. That's why I think he may want to, or Swivel and Illuminate may target ETH markets more. Because one ETH is one ETH, like the price fluctuates. But yeah.
So for our listeners at home, what should they take away, and what are some things that they could do after this episode?
Use Illuminate. Provide liquidity.
Yeah, for real. Like I don't think he could be any more clear and explicit. At least do that, but also really learn about like what it means by the time value of crypto, right? I don't think everyone has really understood that. And because in crypto, there are many different levels to it, right? The time value of holding ETH is different than the time value of holding USDC, which is different than holding, the time value of FXS. So users first can understand that from first principles, and then go look at products like Swivel or Illuminate. But before you do any of that, LP blindly.
Yeah, I think this is what the Gamma Swap guys are saying is like everything has a natural risk-free rate, right?
Correct.
For whatever asset you have, doesn't even matter if it's $1, right? It has a risk-free rate. that you're paying to hold that asset. So you should just be aware of that every time you trade.
And this is
Correct.
the theme of the past 2 weeks, whether it's with Hourglass and Charlie or Julian and Illuminate, is incorporating time into financial products and derivatives. And this will be a theme, I'm sure, in the next DeFi cycle, is having these timed products matured and on chain. And once they're all properly in place, this could, and especially around ETH markets and staked ETH markets and whatnot, like it could really, possibly spark the next leg up.
Possibly could. I mean,
Possibly.
yeah. I mean, this is a market that somebody's been trying to crack into for a while. So if they can do it and figure it out well, I think we're in for a ride.
Yeah. Any final thoughts, anyone?
I liked his comment. Like we really like let all the gamers go at like it's like a badge of honor to be a good like high ranked player somewhere. We
I really enjoyed. Yeah.
We should have known. Yeah, at post FTX, we should have known that like if you can't make top 1% in whatever game you're playing, after years of playing, we should probably discount you as a leader and a builder.
Or maybe not even top 1%, but if you're like below average,
and maybe it means something that he's a top, almost the
elite.
top 5. Well, he's like top 500 in the world when it comes to Overwatch, right? So
I really liked having Julian as a guest.
Yes,
but I really enjoyed listening to him and his insights and his opinions and what he had to say. Like, I definitely have him on again, to see the progress of Illuminate, especially after all these markets launch.
Also, a great recommendation for a future episode guest.
Yeah. What are you gonna say, Ken?
That's a great one. I was gonna say I also like that he asked us questions. That actually foster a great discussion as well too. That was very different. I think only maybe 2 other guests have asked us our opinions. So I really liked how we had a discourse there. That was great.
Yeah. And if you want to get all of our opinions, make sure you hit that bell button and subscribe to us on YouTube. Leave us a comment. Let us know what you think. Give us a like. Lend us your support. And give us a follow on Twitter @Flywheel DeFi. Join the conversation on Telegram @Flywheel DeFi. You can follow me on Twitter @DeFiDave22.
You can follow me at 0xcapital_K.
And I'm at traders_insight.
And subscribe to our Substack, and we'll see you next week. Peace. Everything said on this episode is not financial or tax advice. This channel is strictly for educational purposes and is not an investment advice or solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice whatsoever. Please talk to your accountant and do your own research.